Okay, thank you for coming to this panel. We're talking about staking and institutions, how they can stake better. So my name is Jack Platts. I'm the co-founder and CIO of Hypersphere Ventures, and I'm going to let our panelists introduce themselves.
I don't know what, okay, there I am. I'm Mathias, one of the co-founders and Group CEO of Sygnum Bank. We're a globally operating bank focused on digital assets, but also integrated with traditional securities from custody, trading, staking, lending, and asset management. Also licensed out of the UAE via ADGM.
Hey everybody, Casper, Johansen, founder of Spartan Group. We have an asset management business where we manage about $400 million across one liquid token hedge fund and 2 venture funds. And we have an investment banking business where we advise on M&A and token raises, token launches, and equity raises.
I'm Gibb. I'm the CEO of Twinstake. Twinstake is an institutional staking provider. We service asset managers, hedge funds, ETP providers, family offices, VCs, and some foundations as well. Top level numbers, we manage about 5 billion of client assets currently. Prior to that, just a little bit about me. I spent the majority of my career in traditional finance, made the move over and co-founded Twinstake about 3 years ago.
Assalamu alaikum, Habibis! How are you doing, everybody, today? Welcome to Dubai. Hope you're still alive. It's only day 1, so we've got a long week ahead of us. I'm the Chief Partnership Officer at Swissborg. We were the biggest DeFi lending protocol for retail, so we automate all of your risk rewards for you to earn on your crypto assets. I'm very happy to be with you today.
Great, thank you everybody. So first question is around how institutions approach staking, how they approach some of the risks, and how that might be different than retail.
The retail?
Well, I can start. So I can talk about as part of the Sygnum offering, we do have also a bank-to-bank offering. So we have quite some experience what it means for then banks to look at the offering. And in one example, which I think brings to light exactly what you're asking, is when we were bringing live with staking with Post Finances in Switzerland, the state-owned systematically relevant bank, and that kind of highlighted kind of the key differences in terms of how what is looked at in the go live. First, it took almost 2 years. It was a very thorough, obviously for them to then work with suppliers along the value chain to bring something like this to millions of clients ultimately has a lot to do with how they can put in place or fulfill the regulatory requirements around so-called material outsourcing, which comes with lots of requirements for them to monitor, to do the due diligence on the entire value chain, be it from the node provider to then the custodian or sub-custodian, to how the flows of the assets along the way, how the yield is distributed, etc. So I think it's just a much more rigorous, elaborate process at the highest level. The key topics would be, for example, obviously the legalese, who's responsible for what are the edge cases, what happens if something goes wrong, who's liable for it. So there's obviously the technical work, but I would say even similarly larger part is the whole legal work, the legal framework around it. How can they avoid being, suddenly being involved in terms of governance challenges on the chain, if they're becoming a big part of it in terms of the assets that are staked. It would also be things like taxes, which has been a big topic, particularly in Switzerland, and more, just to kick it off, but happy to pass it on.
Casper, please.
Sure, so I'd say if the difference we're comparing to retail versus how we think about it as an institutional staker, and also how I think about it as a personal investor sometimes in crypto versus when our funds do it, we view our staking relationships with our staking partners as more of long-term partnerships. So we, of course, look at things like the yield and the fees, and often because we bring larger volume, we can also get improved fees. But we look at many more things than that, and probably do much more diligence on our providers than would as a retail investor. So some of the things that we look at, for example, in terms of it being a partnership instead of just a service relationship, is things like getting research from them, being able to ping them, getting insights on new chains, because often the staking providers will actually be very close to the technology, because they're figuring out, do they want to stake it, how can they stake it? So they're more clued in from a tech perspective than many others, so having them as your partner on that. And we even get referrals from some of them for, hey, have you looked at this? Have you looked at that? We've been looking at this. We think it's very interesting. Are you guys investing or interested? We also look at the service level agreements, operational due diligence, and of course very much the track record. So it's a very, very different and thorough and long-term relationship versus if you're just clicking, stake my assets on an exchange or even on a decentralized protocol.
Yeah, so there's a lot more collaboration with the institutional provider. So maybe, you can speak from Twinstake's perspective, Andrew, how that works.
Sure. That's absolutely right, and that's really how we position ourselves to clients, is more of a kind of strategic partner than simply running validators. So when we set up Twinstake initially, we had obviously the whole universe to select from. Do we go retail? Do we go institutional? Do we do both? We decided to go exclusively institutional because we thought that they were two very different offerings. At the time we came to market, I think the problem, the market problem of can you run validators has essentially been solved to a large degree, and that was never going to be the differentiating factor between us coming to market and the players that existed. So for us, it was about, well, how do you actually service an institution, and what's obviously the difference between what a retail offering might look like and an institutional offering. And so running a validator is obviously table stakes, ensuring you protect the downside through your security setup, your infrastructure setup, all your security certifications that go with that, delivering on the upside, making sure you're eking out the alpha on behalf of your clients, but then everything that goes beyond that in the stack. So Casper mentioned a few of them, but even if you just stick to the kind of core staking needs, it's really around sort of any compliance issues, any tax issues that you might want to solve on behalf of your clients, any kind of data reporting and analytics that retail obviously don't really give a monkey's about, but for institutions, some of the unsexy stuff is very important to them. So that's when you start to see the differences in the way, the mindset of retail versus institutions when it comes to staking.
Do you find that institutions are more focused on the security side of things or more on optimizing and juicing yields?
It's a good question. It kind of depends on the institutions. So when we say institutions, it's obviously a significant segment of the market, and you can split, you can slice and dice that in different ways. And then depending on the mandate of the institution, they have different approaches and different frameworks and different internal risk appetites. So for some, I would say most, the primary concern is around security, protecting the downside, right? But in saying that, we like to differentiate ourselves internally by making sure that we are eking out the additional basis points. So it's a nuanced answer, but it's a bit of both.
Yeah, thank you. And Alexandre, maybe you could give us the retail perspective on how retail thinks about it versus institutions and some of your other clients.
Yeah, absolutely. So who here is staking or fructifying your assets? Is anyone actually earning on some assets? So not many, right? And what I've learned in the past 5 years, and our company managed $1.2 billion of assets on-chain lending, and we haven't lost a single dollar. That being said, the industry itself has lost over $100 billion, with 70% of that coming from centralized lending, per se. And so really going on a high level, guys, for those who didn't raise their hands and are not actually staking or earning interest on their assets, the first industry you need to look at is fixed income. What can you earn from traditional finance on your US dollar? So as of today, maybe T-bills will give you 3-4%. Maybe the 10-year will give you 5%, right? And then you have a second industry, which is DeFi, which we're talking about today. And then you have centralized lending. And obviously, there are different risk parameters. And it's very important that all of us, and specifically for the user, not just look at the reward aspects, but both risk and reward perspectives. And that's something that we kicked off in this industry, which we didn't have any risk parameters. Now with protocols like Morpho that let us customize the pools so that we can automate your yields like we do at Swissborg. We can manage the risk, but also optimize your returns. But specifically into DeFi, we won't talk about the risks of TradFi or centralized lending, but I think it's very important to understand DeFi. Other than fixed income, where you'll put your US dollar at a bank and you'll earn interest, the least risky of all strategies is staking. And staking is the most conservative approach for earning interest on your assets. And as of today, roughly the chance of it being slashed, with the slashing risk is the #1 risk when you're staking, are actually quite low. Has anyone been slashed before, lost assets when staking Ethereum or staking on Cosmos or any proof of stake chain? No one, right? Oh, okay, I'm really sorry. I'll get you a glass of wine later to forget that. But most people, if you look at the slashing risk, on Ethereum, it's 0.05, and depending on the pools you're putting in, you maybe lost 1 ETH, and sometimes, the people with good ethics will refund the money that you've lost. At least I know the validators will refund money lost. So conservative strategy, slashing risk, staking. The second level is single coin DeFi lending. And what we do at Swissborg to mitigate the risk for you is not only we choose only specific collaterals when people lend, we choose the collateral or tokens that we believe are safer, but we also only do over-collateralized lending. So that if there is a case where someone gets liquidation risk, because DeFi lending is liquidation risk is the main problem, we would probably manage to keep your money, and we've done that for the past 5 years. And then over DeFi lending, there's LPing, liquidity provisioning. And the risk here is mainly impermanent loss, as you guys know. And by the way, the difference when it comes to DeFi, the main risk is code risk, right? While centralized is human risk, per se. But liquidity provisioning, you have impermanent loss. What does that mean to you guys? It means that if you're staking Solana and USDC on a pool, which by the way, I have many friends, they'll go on Camino protocol and they'll be like, oh dude, I'm earning 40% on my Sol, man. I'm like, yeah, but do you realize that there's impermanent loss? Which means that if the Solana price goes up and people are selling, you will actually lose money over time and lose it due to volatility. So volatility, a risk. And then the last layer, if you're a complete degen and you're crazy, you do what we call yield farming, which means you put your assets, your collateral somewhere, you borrow here, you put them in a second protocol, you borrow again, and then you can stake it somewhere else. And that involves counterparty risk because there are multiple layers. So I think it's just really important for people to really see life through the risk-reward ratio lens for them to decide, what suits their own risk appetite.
Thank you for that. So one question I had was around the operational due diligence aspect of things and how institutions go about picking a provider. And then once they've maybe chosen a couple providers, what are some of the questions that you feel like institutions maybe should ask for those that are providers, or Casper as one that's delegating, what questions that you prioritize most as part of the operational due diligence?
At high level, we already discussed some of it, but it's really to, the hygiene factors such as, for many it's a yes or no that the provider is regulated. There's certain entities that would only work with regulated entities, which already provides a certain level of base comfort. Then there's the level of the general entities, cyber security readiness, for which obviously there's different reports from ISAE to others, the regular audits. Our clients also often ask us for regular pen tests, etc., which we then, the reports of which we share for transparency reasons. So there's this whole cyber element. There's this sound infrastructure. Then it's the what is often underestimated is the transparency around yield pricing, etc. So for example, us as a bank, we have a best price guarantee, which needs to be auditable. That means we have invested quite heavily in dashboards that, if requested, and our institutional clients, they do, we can show exactly also for staking, how have the yields been generated, have they been properly passed on, how is the pricing mechanism, how has our infrastructure done versus other infrastructures, and that on a real-time basis. They would request what the SLAs are around monitoring, what the information flows are if something goes wrong, by when do which escalations have to happen, what are then obviously the rebates, what are the liabilities if something goes wrong. It goes really into the details that are, quite frankly, in traditional finance normal, now just apply to the specificities of staking in this case.
Yeah, for us, it's a lot of the similar points that we look at, so I won't kind of repeat what Mathias said, but we obviously look at the track record. That's an easy thing to look at, and you can look at what protocols they are doing, how they're performing on those protocols versus others, for example, if it's a new protocol. Sometimes you can also, like similar to how I mentioned before, we can get ideas from the stakers on new chains and get views from them. It can also go the other way, where you go and talk to the project team and say, okay, like, I know you work with these 5 stakers. Based on your interaction with them, who do you feel like really, really gets the protocol? Because it can get pretty complicated. It's just not like spinning up a validator and then you're off to the races. It can be very specific for each chain. For us, it's I would say with someone of our profile and our peers, it can be very difficult to break into our account if you're a new startup or you're launching a new service. Because, you know, from a fund manager fiduciary duty perspective, there's really only downside in selecting a small provider if they then do something wrong, get slashed or blow up. You know, like when we invest in an asset, it is first and foremost about that asset and us wanting to get a 2, 3, 5, 10x, whatever the risk profile is on that. And then the secondary part is then, okay, then now let's stake it. And that, of course, provides some return, but you know, to Alex's point earlier, it's also often they're inflationary. So if you're not staking, you're actually losing money. Just like fiat, right? I mean, if you're not earning interest on your dollars, you're losing money because your purchasing power is going down. It's the same thing with a protocol. So for us, it's very much about security, first and foremost, and then, of course, the SLAs, the escalation procedures. Also about customer support. That definitely matters. The BD, the relationship, all that does matter, but security first and then everything else secondary.
Andrew, same to you.
Yeah, I won't reiterate those points, but obviously we've seen sort of hundreds of clients be onboarded at Twinstake, all institutional. And what's interesting is the level or the different levels of DD that we're seeing requested. Talk about the more traditional kind of players coming into the space. They are obviously larger, more sophisticated, slower moving. We receive like hundreds of questions, RFPs that go really, really deep into the security posture, the infrastructure setup, all of our certifications. It's basically an open book. But it is quite a wide spectrum of DD that we kind of see on the inbound. We're obviously happy to provide an open book to our clients. But often for some of the faster moving institutions in the space, it's, you know, time to market's quite important. As we've seen, you know, especially around kind of new chain launches, we try and do this in advance, but you've seen the relative value of staking early on, post new chain launches is much greater historically than it has been once they hit kind of maturation. So that kind of impacts certain institutions' DD. But the points have been made. It's around kind of trust, credibility, track record, they kind of basics. Understanding the risks and considerations associated with staking, slashing risks, liquidity considerations, anything that can potentially impact your stake and your collateral should be well documented, well understood. We're seeing that more and more from institutions, especially in some of the more traditional players that are coming in.
Yeah, are the institutions that are more traditional, are they as interested in the relative value of staking early since the APYs are higher, or they're fine waiting? Those are more the venture capitalists like Spartan and ourselves at Hypersphere.
Correct. With the more traditional institutions, much slower moving as you'd expect. We're still talking about Ethereum and we're still talking about the same things that we were speaking about 3 years ago. So you know, it's maturing, it's happening, it's coming, but we talk about institutional, but you know, that is split out with so many different segments and they all behave in very different ways. And staking isn't immune to that.
Alexander, maybe talk about your users and what they're asking for you at Swissborg.
Yeah, so I want to quickly do a pulse with you guys. Who here believes that we're going to have a really strong bull cycle before summer? Oh, wow, some optimists. Very nice. How about by the end of this year? Okay. How about next year? Okay, wow, it's very mixed. And how about never? No one. So one thing that you asked us earlier when we were in the room was the difference between staking and liquid staking, and having a derivative or a synthetic version of the token. I think for all of you here, for those who think that we're going to have a bull run by the end of this year, it's very important to, as Casper was saying, is to fructify your assets. It's very, very important, especially if we're not talking about a stable coin. If you're staking into one of the layer 0, 1, or 2s, there's a concept called compounded yield, which obviously is something that you really need to look into, because even if you see 5% APY, compounding, you'll actually earn more. And compounding essentially means that if you're earning 5% within that month, you're earning more assets, so you're going to earn 5% based on a higher amount of assets for the next month or the next day, right? But then there's something even more important, guys, since we're talking about strategies, and that is real yield. Has anyone heard of the concept real yield? So real yields, when you have assets that are volatile, and then all of a sudden some of you guys think that we're going to have a bull run at the end of this year, that's even better, because not only you're earning, let's say, 3 to 5% on one of the protocols that you have high conviction, you're compounding it, plus you're earning real yield, which means if the asset goes up in price, you're actually getting a multiplier of that fixed yield that you have at a specific point in time. And for those who care about liquidity, and the difference between staking and liquid staking is simply that when you do liquid staking, you're going to get a derivative, a synthetic, or a wrapper of the token, which you guys saw earlier with Lido. So you're taking a little more risk. That risk could be called depeg risk. So if staked ETH doesn't follow exactly the price of Ethereum due to volatility, you're taking a little more risk, but you're liquid, right? You don't have to wait until the end of the validation period. So as a strategy, and correct me if I'm wrong, guys, I think right now is a really good time to make your assets work for you and really take advantage of not just compounding your yields, but looking for real yields, which could be good if the markets go up, as we say, and all of these optimists are right.
Yeah, absolutely. And so institutional adoption as a broader theme has obviously been turbocharged with the advent of ETFs in Europe and North America, the States, even in Hong Kong. And with Ethereum being a proof of stake network and Solana ETF expected to be approved later this year in the United States, how do you expect those to go in terms of staking? Because right now the Ethereum ETF is not staking. Is that something that the buyers of these products even care about, or not? Yeah, maybe Andrew, if you have thoughts.
So it's a super interesting segment of the market. It's one in which we believe that can enable sort of a decent wave of growth. Obviously gives a large amount of people instant access to a market they would have potentially otherwise theoretically been shut out of. So it's got huge potential, and as you've seen, we've got staking that's permissible in certain jurisdictions, but not others. So the US is obviously the talking point at the moment, and that's a when, not if kind of scenario. So Twinstake has a great market share of the ETF market and within the institutional segment. So about 40% of the European ETP stakeable market is through Twinstake. A lot of the products and staking type services that we build are for those types of institutions. So we have to really understand their kind of the depth of their needs. So it's a very pertinent subject for us. I think when it comes to staking, the key consideration for an ETP provider is around liquidity. Most jurisdictions are now moving to a kind of T+2 redemption time cycle, which means that they have the obligation to meet those redemptions within T+1. As we know on Ethereum, the execute is dynamic and much longer than a day, given any scenario. So there is a mismatch that they have to all internally manage there. We've seen different mechanisms by which they manage it. most obvious one is to just not stake everything. So you run your internal risk scenarios and you say, okay, if I have to meet my T+1 redemptions, how much an extreme risk scenario is my drawdown going to be? And then you just reserve buffers on that. So then you start to say, a follow-up to your question, if the staking yield on Ethereum is 4% on a good day, and then you're only staking a portion of that, so you stake 50%, that's a 2% uplift. Does it matter? Does it not matter? And I guess the answer to that depends. So the market itself now is really trying to look for more innovative solutions to kind of make sure that they're able to maximize those kind of staking ratios. For the US specifically, the big question is whether there's going to be a regulatory set staking ratio, and internally the question is whether the asset managers within the US are kind of pushing for that. But that's a topic, a separate topic in itself. But the more you can kind of maximize that staking ratio, the more yield you can get, and the more competitive your product, and the higher performance that you can pass on to your ultimate clients.
Nice. Does anyone have comments on Europe, maybe Mathias, or in the banking industry, or is that something that clients are thinking about?
I mean, it's for those advanced, yes, but quite frankly, for many, it's just the first step is now getting around to investing in starting with Bitcoin, and Bitcoin ETF is the first big step, an easy step, and now they're maybe as a next step, there's okay, what's next? What else is there? And as almost an evolutionary next step will be to there's yield, and how can we include that yield also in an easy way? We get given we provide staking directly, not via wrappers, even though we can also buy wrappers on Sygnum. We get a lot of questions around can we lend against staked ETH, right? For example, if you stake ETH on a platform, can we use it for Lombard lending, as collateral for Lombard lending? So we're figuring out ways similar to the innovations that you've just mentioned around how it will evolve in the staked assets, ETFs, is what are mechanisms that we can put in place that the liquidity mismatch or the potential liquidity mismatch can be managed from a risk standpoint. So, for example, via option overlays, etc., so that the unstaking periods can be negated in a smart way. So I think that's a similar way of how those that are directly stake without the wrappers are trying to even further leverage these assets, for example, to lend against. I think it's a similar logic, right? So just an evolution, how we can basically financialize the assets as is very common in traditional finance again, but just with this new technology. So I would agree.
Yep. That's one mechanism, one way to do it. Probably, given my background, it's a way in which I'm more familiar with and I think has a lot of legs. The other is obviously liquid staking, but there's some regulatory concerns around that. From an institutional perspective, if you look at the types of institutions that are offering these ETPs and ETF products, it's as I mentioned, they move slow. We're still talking about the kind of older subjects that we've moved on from. So liquid staking is something that they're not yet comfortable with at volume. They're getting comfortable with staking, and we're still doing a lot of education for these more traditional firms around core vanilla staking. So then when you start to overlay the liquidity mismatch and how you solve that through a reasonably elegant liquid staking solution, it's immediately a step too far. So I think that will be one ultimate solution for it, but I see that timeline being stretched, and certainly not something that is picked up in mass this year.
Great. Well, we have 1 minute left. Maybe if everyone wants to take about 15 seconds to say anything about what we've spoken about or where people can reach you. Mathias.
Yeah, I mean, not much more to say. If you want to reach out, best by email or find me on LinkedIn.
No, I think staking is obviously a key part of these protocols. It's actually a functional part of the tokenomics and securing the change, right? So it'll also be dynamic in terms of some supply demand, but I also think that over time, as the asset class matures and as the volatility maybe decreases, then these staking rewards become more important, because now you're doing it for 15% return and another 4% matters versus doing it for a 2x where 4% doesn't matter.
You are almost identical words that I was going to say. The future of staking, and it's always been our sort of
notes.
That's our kind of thesis. Decentralized finance and traditional finance kind of come together. If you look at why people stake, right, the topic of this staking strategies, it's like, well, it's almost backwards to talk about staking as a strategy because most people are in it for the underlying token holding. So we have to, that segment of the market has to mature. And then the staking yield, as you mentioned, becomes more relatively important. And then for us, we look to then go deeper on the staking yield itself, and that can obviously be attributed in different ways. There are different ways in which you can break down the rewards. And then from there, you can start to build out, or you think about the concept of building out a more traditional market on top of that, something like the fixed income market that you were talking about. We work very closely in seeing if there's things we can do around basis swaps or ETH-denominated bonds, for example. So I think there's a whole system that can sit on top of staking, but we are, at the moment, just a little bit away from that.
Alexandre, last thoughts?
Yeah, listen, I think staking, guys, is hugely undermined. If you're not staking already, please try it out, whether you want to choose staking or liquid staking. I mean, when you think about traditional finance, right, actual stocks that have dividends are quite rare these days. If you look at the tech sector, you don't really have many stocks that offer you dividends. And this is a huge value prop for blockchain just to secure the network. It's really something, one of the most innovative tools or technologies in crypto. And I think just as Mathias was saying, and I want to take what Casper was saying as well, right now institutions are looking at Bitcoin. Once they move to Ethereum and they start like buying Ethereum via the ETF, and we start staking Ethereum, imagine the total value locked that we're going to bring on chain. Like there's massive amount of liquidity, and we still don't realize how big it's going to be. And liquid staking gives us access to structured products. You can create indices that give you yield that will eat up into the fees. And just as Casper was saying, I think really there's so many opportunities coming up. So please fructify your assets and take advantage of this beautiful technology.
Great. Thank you, panelists, and thanks everyone for listening.